Hi, this is Mark Zakali at the Macro Institute. I am on for Francois today. So, with the government shutdown in full steam and very little macro data to report on, we'll bring you a highlight of some of our recent thoughts and favorite charts. The deck we'll go through today is from our September conference call, which was focused on a potential change in market leadership from a recovery in leading economic indicators in the United States and around the globe. What this means is that the Mag 7 and momentum may take a back seat for the time being in favor of more cyclical securities. And we'll show you why that is in a bit. But before we dive in, note that some of the slides are not updated through the end of October, but it doesn't change our views. So on page 2, we outline the dilemma that all investors are dealing with. And Francois will tell you this is one of the more interesting macro backdrops he's seen in his career. So the opportunities or tailwinds to the outlook in green really stem from the amount of stimulus in the pipeline, and that flows through from both the fiscal and monetary side. These two factors are supportive of growth in the near and medium term, while infrastructure spending, which is largely AI related, acts as a longer term support to the outlook. So as we shift focus to the right-hand side, you can see that the primary risks all stem from one thing, and that's inflation. Near term, it's the flow through from tariffs on price levels. And the last two really speak to U.S. labor markets, where a lack of available workers, partially due to deportations and demographics, keeps wages and services CPI elevated. So naturally, the question is which factor, stimulus or inflation, is more influential on the outlook? So we'll cover this later, but historically, it is the direction of rates or monetary stimulus that tends to give investors the best signal. So our call on the outlook is generally constructive and supportive of more pro-cyclical or value equities over growth and momentum. In the table on the prior page, we listed 6 key factors that will drive outcomes in the medium term. So we'll only touch on a couple of these today. And if you want the full deck, please feel free to reach out. So we'll begin with the positive side. This is really the most important chart in our deck right now, and it shows the path of interest rates in red against one leading economic indicator, and that's the ISM New Orders Index. The direction of the red line moving north tells us that interest rates are supportive of financial markets well into 2026. We can say the same thing about monetary policy and leading economic indicators globally as well. Roughly 90% of the world's GDP has now cut interest rates in the last 12 months. Other approximations of monetary policies, such as the Fed funds rate and money supply, tell us a very similar story. One of the near-term risks to the outlook comes in the form of tariffs. We can look back at historical tariff rates going all the way to the 1900s on the left. What we see is today's rates that are either implemented or proposed brings us to near unprecedented territory. We can see one byproduct of tariffs, so I'll draw your attention to the chart on the right. We have a bunch of charts that look very similar to this, but what we're doing here is advancing the ISM prices paid series about 9 months ahead of core CPI. What this tells us is that the US is at or near a cyclical trough in inflation and is set likely to move higher over year end as producers are paying higher prices for inputs. And this is problematic because of the inflation sensitive nature of both the US consumer and GDP. Thus far, we've discussed some of the short term positives and negatives. One risk we're thinking about in terms of inflation is long term in nature, and that relates to US employment. This chart really speaks to a backdrop of relatively tight labor markets and the risks of persistent wage inflation. The blue series is job openings, and the red series is unemployed workers. We've really only seen a labor market this tight twice in history. While the gap has closed a bit over the last 2 years, immigration, disabilities, and the number of retirees each day can offset some of the near term slowdown. A recent study by the Dallas Fed indicates they believe the monthly break even payroll number is now down to about 30,000 jobs. This is the number of new jobs each month that keeps the unemployment rate flat. So while we do recognize the labor market is slowing, we think there's enough offsets to prevent a more meaningful move lower. So what does this all mean for stocks? Here in red, we map the path of interest rates, which are advanced forward by roughly 2 years. The stimulative effect of rates is shown by the red line moving higher, indicating falling rates. Here we can see stimulus in the pipeline. It's typically a regime that's very bullish for value over growth. This is shown by the blue line increasing. What we're showing on the right is the contribution of the pure value index, where we see about 45% of its weight is cyclical sectors, such as industrials, materials, financials, and energy. Keep in mind the pure value index is also comprised of non-value sectors, such as the defensives and growth, like healthcare and staples. These typically underperform during periods when leading indicators are moving higher. So let's continue on that theme of value versus growth. So our macro call essentially boils down to a regime of higher inflation and higher economic growth. And the three clips show the last time both moved higher in tandem. The green series shows that it's value that outperforms growth during these periods. So Jonathan, our quant, looked at the prior cycles when the ISM was above 50 and the CPI was above 2.5%. These were our thresholds for higher growth and higher inflation. Value outperformed growth in all 10 episodes on the right. Outside of cyclicality and value, another factor we've been recommending for some time is the foreign sales trade, or overweighting names with a larger revenue footprint outside of the United States. In some respects, we could think of the implementation of tariffs as quasi-stimulus for the rest of the world. The US will likely offer some of the highest inflation rates globally due to tariffs in the near term. At the same time, the US is the most consumption-based economy, therefore tariffs pack the largest punch to its consumers. The series in red is the performance of companies with high versus low foreign revenue exposure. Not only has it performed well since Liberation Day, the blue series shows that it moves very closely with high to low beta, another risk on factor that we've been recommending as well. Thank you for listening in today. Again, I am Mark Zakali. This was just a sample of a few slides from our most recent conference call. If you have interest in the full deck, the macro specialist designation, or the macro boot camp, feel free to reach out to either email provided. Thank you so much.